Hey everyone, welcome back. This is the part two of our SPAC series. We're going to be looking at VGAC. If you didn't watch part one, we just go over kind of the overview of SPAC and how the economics are not really in the favor of the investor, but more in the founders of the SPAC and of the company that is going public. Um, so VGAC, if you're not familiar with it, this is Richard Branson's SPAC. The CEO of it is Josh Bayless. The CFO is Evan Lovell. They are both on the executive board or executive committee for Virgin Group. Evan is the chief investment officer and Josh is the CEO of Virgin Group. So this is really just a Virgin Group SPAC per se, with Richard Branson as the poster child for it. If you weren't aware, right, it IPO'd back in September of 2020, and then in February they announced that they would be merging with 23andMe for $3.5 billion enterprise value. The SPAC, when it was first created, just something to note here, it was focused on acquiring a company that operates in the same space as Virgin Group, so travel, leisure, financial services, health and wellness, technology, music, media, and renewable energy. So pretty broad, pretty much every category, right? So all sorts of stuff there. IPO price was $10 a share. It was originally 40 million shares, but then the green shoe provision was exercised by the banks, which allowed them to issue an extra 15% of shares. So we saw 46 million shares issued, $10 a share, so $460 million. And then in addition to this, there's a founding sponsor, VG Acquisition sponsor, which is probably mostly Richard Branson with some other outside capital. But they purchased about 7 million warrants at $1.50 a warrant with an exercise price at $11.50. So I guess really the thing to note here is they're limiting their downside. Instead of buying 7 million shares for 70 million, they're spending $10 million for basically call options. So it kind of limits their downside exposure. So if the SPAC goes belly up or loses money, they're not losing 70 million, they're losing 10 million. The warrants, they're exercisable 30 days after the completion of an acquisition or 12 months after IPO. And then to note here, so if you watch the first video in the SPAConomics section, right, we talked about how the founders get a pretty hefty finder's fee in a sense. So for VGAC, the founding members spent $25,000 and received 11.5 million shares of Class B stock. These Class B shares are redeemable one for one for Class A shares. So they ended up paying 0.002 cents a share. So right, if you got in at the IPO at 10 a share, you paid quite a bit more already than the founding members. So we'll talk more of that in the third video about what that means as a shareholder. And then the Class B shares in the SPAC actually hold the right to appoint directors and decide on the acquisition. So another interesting thing there, and they opted for a 24-month time frame. If they couldn't acquire a company then they would return money to investors. Combined entity, just real quick, it's going to trade under a new stock ticker, so not VGAC, but it'll trade under ME for me, 23andMe. In addition to the funds raised in IPO, there's going to be a $250 million PIPE offering, which is just private investment in public equity. Basically just follow-on offering to provide more cash into the combined entity. Interesting thing about here though, which is nice to see, Richard Branson and Ann Wojcicki are each putting 25 million into the PIPE. So, they'll actually have skin in the game, which is good to see. And that offering is at $10 a share, so they're not getting a discount. Well, I mean, technically they are getting a discount because it's trading at 10.46 right now. It was up at 16 a couple weeks ago, so could end up being positive for them if the market does perceive this acquisition positively. At time of close, they'll have 900 million of cash on the balance sheet, which is good. A lot of liquidity. Expected to close in the second quarter of 2021, so pretty quick closing, which is the benefit of a SPAC. And then post-merger, here's the ownership breakdown. 81% is going to own by the original 23andMe shareholders, 11% by VGAC shareholders, and that's going to be the Class B and the Class A shares. 6% is the PIPE equity piece here, and then 2% is the VGAC sponsor. My guess is that's the warrants. They've probably actually converted some of those. But But yeah, so it's definitely an interesting structure. Pretty typical, I would say. I think they took 17% of the company, right? If you do 11.5 million divided by a total of 57.5 million shares outstanding, um, they took 17% roughly of the company for free. So, big finder's fee there for them to go find 23andMe and take it public. But yeah, in the third video, we're going to touch on 23andMe, kind of the business there, some of the highlights of it, and then we'll touch on the SPAConomics and look at how much of a finder's fee the Virgin Group executive team walked away with for this. If you have any questions or comments, leave them below. If not, check out the rest of the playlist, and we'll talk about 23andMe in the next video. Thanks.